Hello, I want to talk to you today about long-term care insurance for federal employees. Okay, I've had this topic come up a few times here in the past month or so. Yeah, I've written some about this topic before, but thought I'd do a video today to talk about a few aspects of long-term care, what to consider, and what the risk is. So let's talk about it. Talk about long-term care for federal employees. And the first question is, what is the risk? Okay, is it a risk that I need to insure? And I'm going to say yes. Okay, it is a risk that you need to consider and see what you're going to do about it. All right. So I think it's better than one in two that one person in a married couple is going to need it. Uh, and that's just off of the top of my head, but it is a very legitimate risk. Okay, the odds of needing care are somewhat high compared to other insurances, other risks. Um, if you need care, the average stay in a nursing home, I believe, is 2.2 years. It's somewhere around 2.2 to 2.5 years. So that's what the average stay is in a nursing home. So if you're looking at options, something you may need to know. Now, how do you figure out how it's going to impact you? So here's how I do it. I do something really simple. Okay, can't spell. I use just cash flow software. Okay, I have software. I put it in sources of income, so your first annuity, your Social Security, and then investments. And then we do something like, say we're going to have a long-term care event. Uh, long-term care event for, I typically use 5 years. Maybe we even use 7. Now, I just said that the average stay is somewhere around 2.5 years. However, I don't really want to plan for 2.5 years. I don't know about you, but I would rather plan for a worst case scenario. So, not that you can't need care for longer than 5 years, but yet that's longer than the average. Okay, so I feel like if you plan for 5 years, all right, then you'll be in good shape if you plan for this and you only need care for 2 years. Okay, so I use something like a long-term care event for 5 years and use expenses of about $70,000 a year. Now that $70,000, it's going to vary depending on your area, where you're at. If you're in a high cost of living area, you're in a New York City, LA, somewhere like that, out west, Oregon, Washington, Seattle, it's probably going to be higher. Okay, if you're in the Midwest, it may be slightly lower than that. But what I'll do is I'll put this expense in of $70,000 and then see what happens to your cash flow. Okay, and you'll have a chart of your assets. You're looking for something like this going up or something staying flat. What you don't want to have is you're plodding along in retirement, somewhat flat because you're taking distributions out. Then you have a long-term care event right here, and all of a sudden assets tank. Okay? Problem with that is now your community spouse does not have the assets to be able to continue their lifestyle. Okay? To me, that is the biggest risk of long-term care. All right? Married couples where one person can need care and then spend all the money for the two of you, and that community spouse is left with not much money to create an income on retirement. So, if this is going to happen, should you need care, okay, now you've got a couple options. So your options are, you've got option one, and that's pay for it out of cash flow, okay? So if the assets aren't going down, remember, okay, then you have the option of paying for it out of cash flow. Or if they are going down, that's still an option, but you need to understand what the risk is and what impact it's going to have on you. Then if your assets aren't going to go down, it's still an option to address long-term care. You still may want to insure it. you may decide the benefit is worth the risk. Okay? So that's option number one. Option number two is getting a traditional long-term care plan. All right? So if you do this, I would recommend looking at all options. Okay? So option one is going to be the federal long-term care plan. You can go on, it's fedsltc.com, something like that. I think there's a dash in there too, but you can go on there and you can apply for a policy. All right? Those policies, they're pretty simple. They don't have a lot of bells and whistles on them, but I don't know that you necessarily need those. All right? And if you're going to get a policy, just a policy on yourself, or a policy on yourself and then your spouse, so individual policies, the federal program has pretty good rates. Okay? So I would still compare it to private companies, getting your own policy versus not through the federal program. But from what I have found, the federal program typically has good rates. However, I would also look at private insurance. So private insurance just means going out and getting it on your own. There's a few companies that do it still. John Hancock, I believe, is one. They're limited. Genworth, I believe, is one. So there's very few companies that actually provide long-term care anymore because the companies have been having losses on those insurance policies. But I would recommend looking at those companies because, for one, you just want to compare rates, but two, a lot of those companies have what's called a shared care rider. So if you get a long-term care policy just on yourself and say it has a 3-year benefit, okay? If you don't use any of that benefit, you die, that benefit's gone. You didn't get anything out of it, okay? If you have a policy on yourself and a policy on your spouse and you guys get a shared care benefit with those policies, again, this isn't available through the federal program, but through a private company. If you have that shared care benefit and you each have a 3-year benefit, I have the 3-year benefit, I die, now my wife still has 6 years of benefit that she can use, okay? So you can share the benefit between the two of you, which increases the likelihood that you will use the policy. So I really like the shared care benefit. I would recommend looking at that and weighing the cost of that versus not having it. Okay, so that's option number two, getting insurance, insuring the risk, all right? These policies are typically going to have an elimination period, which is like a deductible where you won't have any coverage for something like 90 days, okay? And then the policy will kick in after that, and as long as you cannot do 2 activities of daily living. Activities of daily living are things like going to the bathroom, dressing, transferring, moving one place for another, eating, essentials of daily living. Then option number 3, which a lot of people don't think about, is life insurance. Okay? So, and this can come in really 2 different forms. So, what's one of the biggest downfalls of getting long-term care insurance? Why would you not want to get it? Well, the answer to that most always is, I don't know if I'll need it. I don't know if I'll ever use it. So you could get, and it's not cheap, so you could get policies for yourself and your spouse. It may cost $5,000 a year. You pay for it for 20 years, spend $100,000, and then you never use it. Okay, so that $100,000 is gone, right? Well, on the other hand, you could get life insurance, okay? There are a number of life insurance policies now that have long-term care riders on them, which allow you to access the death benefit while you are still alive, okay? So if you have a $300,000 death benefit, they will allow you to access that while alive for long-term care, okay? So that's one option. Option number 2, as far as using the life insurance, is that you could, if you have a spouse that needs long-term care, you could go ahead and use your assets for long-term care, okay? Go ahead and take distributions out of IRAs, TSPs, wherever it may be, pay for the care, because during that time period, you're gonna have a large amount of deductible expenses for taxes. So that's $70,000. Not all of it, but there's oh, forgot what the name of it is, but it's 7.5% or 10%. Any expenses above that of adjusted gross income. So say your income's $70,000 and it's 10%. Anything above $7,000 is going to be tax deductible. So if you have $63,000 that is tax deductible, then that's lowering your income by $63,000, which means you can take money out of qualified accounts like Thrift Savings Plan or IRAs and essentially not pay any taxes on it because it's going to be offset with that deductible healthcare expense. Okay? So you could do that and pay for the care, and then at your spouse's death, then you have the life insurance to replace the assets that you spent on your spouse's long-term care. Okay? So that's another way of using life insurance. Now keep in mind, these aren't exactly the same thing. If you're looking for, in my opinion, if you're looking for the best coverage specifically for long-term care expenses, your traditional long-term care policy is probably the best way to go. But keep in mind, it's still going to have limitations. You have a benefit period of 2 years, 3 years, 5 years, whatever it may be. Then with life insurance, your cap there is going to be whatever that death benefit is. So if you're tapping it while you have the policy in place, you have a long-term care rider, then it's going to be limited by whatever your death benefit is or what the policy says. Okay? If you can access 100% of the death benefit. And then the other way, if you're just going to pay for long-term care out of pocket and then be replenished by the life insurance and a spouse is passing, you never know. You could run out of your assets, okay, and then not have money to pay for more long-term care. So that's a risk as well. Just trying to make you aware of all the risks here. But now pros. So benefits of life insurance over long-term care. The biggest benefit of life insurance over long-term care is there is a guarantee that somebody will benefit. With life insurance, as long as you pay the premiums, then somebody's going to get a death benefit at your death, right? Or whoever the policy is on, there's going to be a death benefit paid out. Where with long-term care, it's kind of like car and home insurance where you pay for it hoping that you never use it, right? I've never met a person that says, man, I'm going to get a long-term care policy. I can't wait to get into that nursing home. Because it just doesn't happen. Nobody wants to. So one other benefit of life insurance over long-term care, you can get a life insurance policy that has a guaranteed death benefit for a set premium. Meaning you pay this much money, you're going to get this, somebody's going to get this death benefit guaranteed at your passing. Okay? Where with long-term care, premiums are not guaranteed. Okay? And any of you that have had a long-term care policy for any extended period of time are aware of that by now. The federal program has taken multiple rate increases, and they haven't been small ones. Okay? There's people who have seen 100% rate increases. So with life insurance, typically your premium is going to be set and it's not going to change, okay? As long as you get a guaranteed death benefit policy. The long-term care, that's not the case, okay? When you get it, it's designed to be the same premium for the rest of your life. However, they can increase rates. And every carrier that offers long-term care policies has increased rates on existing policyholders, all right? So that is a quick overview of long-term care, how to determine if you're going to need it, look at your cash flow, run a couple cash flow simulations, see what kind of impact it's going to have on you financially. Then determine what you're going to do, because long-term care is a risk. It is a valid risk that you need to address. And you got really three options, in my opinion. You pay out cash flow, you look at buying long-term care, or you get a life insurance policy to do it. There are some asset-based policies too, which could be an okay thing, but I'm not going to get into those. They get more complicated. But These are your three simplest forms of paying for long-term care. All right. So if it's a risk, address it, and then look at insuring it today if you believe it's a risk. Okay. If you get it today, like if you get life insurance, premiums are going to stay the same for the rest of your life. They should. And even long-term care, even though they may have rate increases, if you get it today at the age of say 60, premiums you will pay the rate of a 60-year-old for the rest of your life, versus waiting until they maybe turn 65. Now, hopefully your health hasn't changed. Hopefully you can still get a policy, but then you're going to pay the rate of a 65-year-old for the rest of your life. All right. So I hope that helps. If you have questions about long-term care, feel free to post a question in the comments, and I'll do my best to answer. Thanks.